How can you make sure a company's operating leases are represented fairly on its balance sheet? In this tutorial, you'll learn how HOLT capitalizes operating leases, removing a common distortion created when traditional accounting treats these leases as off-balance sheet items. The HOLT methodology gives you an objective view of a firm's real cash flows, obligations, and assets employed. Let's start by reviewing how companies finance various types of asset purchases. Most purchases are accounted for on the balance sheet. When a company buys an asset or enters into a capital lease, these are recorded as assets and liabilities. However, when a company signs an operating lease agreement, most accounting methods charge it as a rent expense over the term of the lease, with no related asset or liability appearing on the balance sheet. This discrepancy reflects the accounting for a financing choice rather than a difference in economics. It's difficult to make a true comparison of companies with different lease capitalization policies, since their assets and debt levels are not comparable. The HOLT methodology removes the effects of this financing decision by capitalizing all operating leases. Regardless of whether a company leases or buys an asset, the economics are the same and the profitability now can be compared. Let's examine UPS and FedEx, two competitors that tend to finance their assets differently, to see how HOLT adjusts the numbers to make them truly comparable. UPS owns a majority of the assets used to run its business. In 2010, UPS reported total assets of $33.6 billion. FedEx, on the other hand, leases a large portion of its assets. Because the leases are off balance sheet, FedEx reported total assets of just $24.9 billion in 2010, nearly $10 billion less than UPS. The company notes also reveal that UPS had $615 million in operating lease expenses, while the figure for FedEx was $2 billion. Capitalizing the full impact of operating leases, the balance sheets increased dramatically. UPS's balance sheet grows by 75%, but FedEx's balance sheet more than doubles. As a result, FedEx actually has a larger investment base than UPS, including an additional $25 billion in assets that would have been missed with traditional accounting methods. That's nearly 39% of the adjusted HOLT asset base. Using these adjusted balance sheets to calculate CFROI, we see that in 2010, FedEx earned a CFROI of 3.5%, while UPS earned a CFROI nearly 3 times higher of 9.6%. UPS earns a higher return on its investment base than FedEx. Applying the HOLT methodology also reveals an important difference in lease obligations. UPS had obligations of $5 billion at the end of 2010, while FedEx's obligations were much higher at almost $16 billion. This debt component will be an important consideration when figuring out the equity valuation for each company. Now that we know the importance of this adjustment, let's look at the basic inputs used to calculate the value of the operating lease asset and the lease debt. We'll continue to examine FedEx. To capitalize the operating lease asset, we start with current year rent expense and discount it over the life of the lease. The debt rate used in the calculation is simply the debt rate of a single A-rated firm. The lease life is based on HOLT's calculation of the firm's overall plant life, which is gross plant divided by depreciation expense. Next, in order to calculate the debt related to the operating lease, HOLT estimates and subtracts implied accumulated depreciation from the capitalized operating lease asset. The implied depreciation is based on a firm's average historic growth rate in assets and lease life. Given FedEx's historical growth rate of 4.9% and lease life of 16 years, HOLT is able to delayer the $28 billion capitalized operating lease asset. Once the asset is delayered, simple straight-line depreciation can be applied to estimate annual depreciation. After subtracting an estimated $12 billion in accumulated depreciation, FedEx's capitalized operating lease debt totaled $16 billion last fiscal year. Using the same process for UPS, capitalized operating lease debt totaled $5 billion. By measuring the cash return for all assets of the company, including off-balance sheet operating leases, HOLT provides true comparability among companies, regardless of industry or country.